GC, talk me into it, man. What are you seeing in the market right now? What is top of mind?
Well, for those who attend the quarterly real estate update, you're going to kind of see a trend here. I bring the same type of indicators to share with you because I want you to be able to measure things. You want to be able to look for certain things when you're thinking about how your money is performing. And I want you to see the same things over time, because that way is going to bring confidence and stability and education as to how you know your money is performing. So we're going to start the same way that we started, the last few quarterly calls. We're going to take a look at pricing. Okay. We get a lot of questions about what's going on in pricing, what's going on in pricing, a lot of insights that you might not necessarily have as a not your average investor, which is what our clients are, versus what you may be reading in the headlines. So let's take a look at pricing here in Jacksonville, Florida.
All right. We're going to share our favorite chart here. And GC, I think we're going to go into a speaking point that you had addressed early, almost over a year ago. You started talking about this.
Yeah. It's really fun because I actually went back and looked at our quarterly real estate market updates a year ago and 9 months ago. And the first thing that jumped out to me was the headlines that were out there at that time. And I shared those headlines with you, and the tone of the conversation was very different. As you're looking at pricing here, for those who aren't familiar and might be joining us for the first time, this is a graph of all of the median home sales prices in Jacksonville, Florida. The blue line is every median home sales price on a monthly basis going back to 2001. And that red smooth line that goes right in the middle there is the median projected home sales price. And that's based on what the average home price appreciation has been each year in Jacksonville, Florida. And so what you see here is really over the last year or so, you saw some fluctuation. And a year ago, we were right in the middle of those prices going down, down, down. And I'm sure you all remember as well, the headlines everywhere were calling for the crash, the real estate crash that had to happen out there. And we, in our own little small section of the internet here, in our small but mighty client list of 1,600 plus folks, we shared the message that we did not see a crash happening. We saw normality happening in the real estate market. We saw that the fact that prices was going down is actually normal. It's called seasonality. And we shared data to show that, listen, almost every single year for the last 20 years, home prices went down from June to January, which is exactly what happened here. And so we were one of the only ones to say that we fully expected home prices would bounce back up.
That's right.
And what do you know here? For the last year, you look at it, home prices in Jacksonville are largely flat. Which is exactly what we said, and exactly the value of looking at data, having perspective, and having an insight that is not normal and not average, for the marketplace. And it pays off pretty well for our clients.
Yeah. And I remember you not only predicting that seasonality would take place, so there would be like a dip that comes back up, right, to keep it flat for the year. You also had the foresight to know what headlines were coming. You were talking about, hey, watch this, right?
Yeah.
This is what you're going to see. We saw those headlines talking about month over month, and they were talking about the month over month decline and predicting this next decline or whatnot, right? So how has that matured out in your eyes, GC?
I'm so glad you asked. So I pulled some of the headlines here when I did a quick Google search of recent headlines, and look at the headlines that are out there now.
Look at that.
There was the great housing crash of 2023 that wasn't, and then as home prices rose for the 6th month in a row, according to Case-Shiller, we were saying that you're going to see surprise in the marketplace that home prices are going up when there really shouldn't be surprise. It's called seasonality. When it's cold out and snowing in many parts of the country, guess what? There's less demand for housing because less people are out looking at houses. And home values go down towards the end of the year in the retail marketplace, not necessarily for what we do. But then when spring comes and summer comes, guess what? Home prices go back up. It's normal seasonality, and it's one of the benefits of being a JWB investor and a member of our Not Your Average Investor community, because we have that data, but we have perspective of doing this for almost 18 years. Yep. Right. And that's what you really need at a time like this to make effective decisions with your money.
So speaking of a time like this, and speaking of effective decisions to make with my money, I would assume that there is a majority of people that come to this call that are wondering if right now is a good time to buy. Is this a moment to wait? Is this a moment to buy? Is this a moment to hold? What do you think, GC? What do you think people are asking themselves right now?
Well, I think what people are asking, I think they're there's a general fear for how to invest right now. It is not as striking a fear as it was maybe a year ago, but there's definitely a general feel. People are uneasy. They have seen that real estate hasn't crashed. And so people are open to the idea of investing in real estate, but they're asking themselves, should I wait? Should I wait for home prices to come down? Should I wait for interest rates to come down?
Yeah.
So I started to think about this and I'm like, well, those two questions are really good questions to ask. But I've been investing since 2006, 2007, and I have been met with more than a few really good questions to ask about whether or not to invest in real estate. So I started to think, and I think you guys will enjoy this, I started to think of all of the great reasons to not invest in real estate in Jacksonville, Florida, since I started to invest. And then I wanted to put some data behind it to show how that's worked out.
Got it. So we're going to put a little bit extra perspective, right? We're going to look at prices and interest rates and where they are right now, but we're going to look at the perspective in the sense that it's one thing to look at where we're at right now. It's also a good thing to look historically about decisions that we would have made and how we would have felt making those decisions as well, because you've been doing this for 18 years.
And there's a reason why this asset class performs.
Correct.
It performs really well, even when there is a down economy. And so I looked at some of those times. Let's first start at 2007 to 2009. Just to put it in perspective, my business partners and I owned about 40 rental properties at that time. That was, 16 years ago, 17 years ago now. And that was a time when there was real fear in the marketplace. And I hadn't been through a full market cycle at that time. So I was going off of what the books told me and my mentors told me, but there was fear for me too. Well, I'll tell you how that worked out, right? At that time, we were dealing with the Great Recession. There was a housing crash. In Jacksonville, home prices were on the verge of dropping about 35% from their peak to their trough. And we had really high foreclosures. About 40% of all sales at that time were foreclosures. And, that's not a good thing for home prices, because when a foreclosure happens, it sells generally at a discount and that weighs prices down. But, I invested.
I'm acutely aware. Yeah.
And I'll tell you how that worked out. So, and maybe this is news for most of you out there. Since then, from 2007 to 2022, even when you had all those reasons to not invest in real estate, all we've seen is an average of 4% rent price appreciation year over year, which is higher than the average, the historical average. All we've seen is home price appreciation of 3.8% year over year since 2007 to 2022. And then I started to put some dollars to this because I wanted to show people how much money inactivity and indecision and not making the decision to invest has cost people. If you were to buy one property in Jacksonville in 2007, you would have pocketed about $155,000 just in appreciation of that asset. That's not even saying there's those other profit centers. It's $155,000 has been left on the table from people who did not decide to invest. Clearly, those are good reasons to consider, but the inactivity, not doing it, $155,000 on the table just for one property.
Got it. So that was the Great Recession when you were thinking, I can't be buying rental properties when the real estate market is crashing. Fair. That being said, inaction would have had this opportunity cost. Let's go to the next period where you would have been thinking, maybe you don't want to invest.
All right. 2010 to 2011, very high unemployment. I was even surprised, right? We're in an unemployment environment now. It's extremely low in the 3% unemployment, even lower than that in Jacksonville. This was a time where we had nationwide unemployment of over 9%.
Yep.
Most people would say, I can't believe that you're going to invest in real estate if so many people are unemployed. But guess who continued to invest in real estate?
This guy. Genius Concepts.
Well, many people weren't calling me a genius at that time, I'll tell you that. There was new financial regulation, which makes it harder for banks to lend money. These are all great questions. Many people didn't understand how this was going to affect all asset classes. But all that's happened since 2010 and 2011, you've had an average of 4.1% rent price appreciation per year. You've had an average of 7.2% home price appreciation per year since 2010. And for those who made the decision not to invest, again, for reasons that are good to consider, but you would have left over $203,000 and forfeited that had you not made the decision to invest, even in those times.
There you go. Opportunity cost of inaction would have been missing out on this stuff, right? Even when it was high unemployment and new financial regulations. Next period where you're thinking about maybe not investing.
All right. So now let's go to the COVID pandemic, right? 2020 to 2021, there was a recession at that time, extremely high unemployment for some period of time. And there was this new thing that we had never experienced as an asset class before, eviction and foreclosure moratoriums. Paulo, can that be a good time to invest?
That was pretty scary. I remember those days.
Yes. But on this show, we talked about how this is a critical need. And if there's one asset class that you want to be investing in a time like this, you want to be investing in a critical need. And since 2020 through 2022, all we saw was an average of 9% rent price appreciation per year and an average of 15.5% home price appreciation per year. And just since 2020, if people had sat on the sidelines and did not invest like you invested, you invested in 3 homes since 2020.
I did.
Others who did not make a similar decision forfeited $125,000 roughly by not making that decision.
There you go. So again, inaction would have been letting, the opportunity cost was 9% rent appreciation. That's increased cash flow, 15.5% home price appreciation, and a nice chunk of equity that has happened in a very short amount of time. And then let's go to one more part where it's difficult today.
And here's where we are right now. Okay. We're in high inflation times. Still, inflation has come down. It's still high. We are in a high interest rate environment, relatively speaking, right? We have gone from interest rates in the 3%. Now for the average investor out there, you're getting closer to 7 and almost 8% interest rates. JWB clients get less. And that's shocking to many people. And there's another possible recession looming. So many of you, I'm sure, saying what is going on in your mind, but you're saying, how can this be a good time to invest? Well, since 2022, when these same conditions were in place, if you made the decision not to invest, you would have foregone 10% rent price appreciation. You would have foregone 9.9% home price appreciation in 2022. And you would have left $31,000 of equity gains. That's just from home price appreciation on the table. So my point here is that there is always going to be reasons to not invest. But this asset class shows over and over and over again its resiliency and its profitability, not just in good times, but in bad times. And it's hard to have data like that for the other places that you're putting your money. And that needs to be understood because now is a tougher time. It takes more courage to invest today than it has for largely the last 10 years. But certain asset classes are built to perform in bad times as well as good times, and most are not.
As I look at that chart that you put together, and I like this because we're going to get into today and what the conditions today look like and what that means for your investment making decision. But I think illustrating that at all these different points, there was a reason to not invest, and you got to pass it through the filter of what happens historically. It really illustrates that thing that I keep hearing over and over again, that there's always a reason to wait to buy real estate, but what you really want to think about doing is buying real estate and waiting because it works, right? And especially in this workforce housing asset class that is so well insulated in a growing market like Jacksonville, to me, that really, really illustrates the whole thing because Jacksonville has been growing through the majority of that time, right? And this has always been the workforce housing stock that has always been undersupplied.
Absolutely.
Got it. Cool.